Welcome to BBW and our brief presentation on how to borrow money using your super to buy investments. We are of course referring to self-managed superannuation. A self-managed superannuation fund is an entity, the same as a company or a trust. In fact, a self-managed superannuation fund is a trust, set up and controlled under relevant legislation set by the Australian Taxation Office. A self-managed superannuation fund operates the same as any superannuation fund. It has the same tax benefits, it has the same member benefits, and it operates under very similar legislation to your managed superannuation funds. Anyone can set up a self-managed superannuation fund, employers and employees, and they can transfer money from existing funds into a self-managed fund, and in fact an employee can have their contributions paid to self-managed superannuation funds. There are several advantages and reasons why people set up self-managed superannuation funds, including, and most distinctly, gaining control of their investments and exactly what their investments are placed into. They are also able to access a much wider range of investments, from shares and property through to antiques and arts. They can fix their costs and, as a result of changes to recent legislation, superannuation funds can now borrow money. The ATO introduced legislation which allowed superannuation funds to borrow their money in September of 2007. This new legislation introduced by the ATO creates a huge opportunity for both employers and employees alike. This opportunity is simply that they can access and utilise their super to borrow money to acquire investments. It's referred to as leveraging. A simple example can explain exactly how leveraging is an advantage. If you had a superannuation fund that had $60,000 in it and it borrowed $240,000 against that, it then has $300,000 with which to go out and acquire investments, including property, shares, both, or other investments. A 10% return on $300,000 is $30,000. 10% return on the original $60,000 is $6,000. The difference is clear. Establishing the structure to run a self-managed superannuation fund and access your super to borrow money is relatively simple. I'll use the whiteboard now to provide you with a demonstration of how this process is achieved. Alright, the first step of the process is to establish your self-managed superannuation fund. The self-managed superannuation fund has a trustee company. This self-managed superannuation fund in this example has two individual members that are able to make contributions to the self-managed super fund. The next stage in the process is to roll over money from existing superannuation funds into the self-managed super fund, creating a cash pool. The next stage in the process is for the self-managed superannuation fund to create the security trust. The Australian taxation legislation requires that any assets that are held as security for borrowings must be held in a separate security trust. The security trust has individuals as trustees. Generally these individuals are the same people or similar to the members of the superannuation fund. The self-managed superannuation fund then enters into a warranty agreement with the security trust. That warranty agreement provides for a deposit to be paid to the security trust and also for regular payments to be made to meet the costs of the security trust ongoing. The security trust, or the individuals and the individual trustees of the security trust, then identify their asset that they wish to acquire. Once you've identified your asset, you have the deposit money within the security trust, you can then go out and approach a bank. It is in this situation that our structure is superior to many others. The reason for that is that there is a separation between the security trust and the self-managed superannuation fund, to the extent that the bank or the security trust itself will approach the bank directly to obtain the finance to acquire your asset. This essentially means that the trustees can act as guarantors for the loan, and the trust itself is the one borrowing the money from the bank, consequently removing the self-managed superannuation fund from the borrowing action. This essentially means, in this circumstance, by running through this structure, that you can utilise a variety of different types of loans available from the bank and use standard loans, and thereby reducing interest costs and administration fees to obtain the borrowings to acquire the asset in the first instance. Once the asset is acquired, the warrant agreement continues to act, whereby payments are made by the superannuation fund to pay out the bank loan. These payments may be funded through the original cash pool, or in most circumstances contributions are made by the individuals to the super fund, which then goes to the cash pool, which then goes to the security trust under the warrant agreement, which repays the bank. Essentially what that means is that principal and interest payments are being made by the individuals as contributions to the super fund in the first instance. This means that those principal and interest payments or contributions, which are then repaid to the bank, are fully tax deductible, subsequently creating a significant advantage over a standard geared investment directly through an individual, whereby only the interest can be claimed as a tax deduction. In this circumstance, both the principal and the interest can be claimed as that tax deduction. The debt with the bank or the borrowings from the bank may be for a short term or for a long term. By way of example, if you're a 30-year-old, once again with the $60,000 in superannuation, and you go out and you borrow the $240,000, have $300,000 and acquire an investment property and pay that investment property off over a 30-year period, then essentially by the time that investment property is paid off, you have reached retirement age. What that essentially means is that the capital growth associated with that investment, you may well sell the investment at that point in time. Because you're at retirement age, there is no capital gains tax back in the self-managed superannuation fund as a result of the sale of that asset. Further, because you'll be receiving a pension at that point in time, that pension is also completely tax-free under this legislation. So not only have you gained the advantages through the principal and interest tax deduction through the life of the loan, but at the end of the loan you've been able to realise your asset for 0% tax and realise that benefit through a pension payment at a continued 0% tax rate through the self-managed superannuation fund. Superannuation funds also provide advantages by being 100% protected from creditors, and also ongoing tax advantages through the reduced rate of only 15% tax. Other advantages can be achieved through this structure for employers for the acquisition of commercial property, that is the borrowings against it, and consequently operating from that commercial property, thereby providing significant tax advantages to the employer. Further tax advantages can be obtained by employers who already own commercial properties, whereby they may transfer, whether that property has a loan against it or not, whereby they may transfer that property back to the superannuation fund and claim tax deductions for the transfer of that commercial property over a period of time without paying any cash, consequently obtaining tax deductions for a no cash payment. As you can see, this is a unique and exciting opportunity available to anyone with super, and BBW Group will partner with you to help you achieve this rewarding opportunity.